So let's work through the section A here. What I won't do is read every single question out. I'll have the question on the screen. You can obviously pause the recording, read it yourself, and then unpause it. One thing I would do when sitting these exams, although I'm working through this in order, so I'll do section A first, I would use the navigator and I would jump to section C. The reason being, sometimes things come up in section A and B which can help with my section C answers. And if I do come up to anything like that, I can pop it in the scratch pad, something like this. Question 13 helps section C, and then I know I can jump back and maybe there's a bit of useful information in there. The only way I can do that is if I know what's coming up. So I just quickly skim read what I'm being asked. I need to explain these 4 characteristics of a service business. We've got to populate this template based on the 6 dimensions of the building block model, calculate the contribution for each of the 3 sizes of work shoe, do some variance calculations, and comment on the reason for those variances and discuss whether the learning curve effect is still relevant. So all I've done there is just primed my brain to keep an eye out for any of those questions, and then I jump back to question 1. As I said, I'm not going to read each question out. You can pause the video, read it with it paused, and then unpause it. These questions, you have to drag each of these tiles and drop it where you think it would sit in terms of the order. Sometimes some of them are obvious and some are less obvious. One approach is to top and tail it. I work from steps 1 as far as you can go, and then go in reverse, and then that might leave a couple that you then need to make a decision on. Because we're looking at target costing, the first thing is always to derive the target price, and the last thing is to estimate the cost gap. Once we've got our target price, that's when we can work out our target profit. From that we can calculate our target cost, and then we compare that to the forecasted cost in order to estimate the cost gap. On to question 2, I always read the requirement first, then the setup, and the options here are all 4 permutations of whether we sell products Q and Y before or after the special handling process. The apportioned joint costs are considered sunk costs, so we don't take those into account. These sorts of questions, we know we're going to have to do some calculations. We're going to have to do it for product Q and product Y. And often the trick is just thinking what's the most efficient way to get to an answer to know whether we should sell product Q before or after the additional handling, and same for product Y. What would drive me here is I can see the before and after prices are done per kilogram. I've got kilograms down here and I've got fixed costs, and then the variable costs are per kilogram. So what I would do is convert the fixed costs into a per kilogram amount, add it to the variable cost, and if it's less than the additional $21 I get here or $15 we get here, yes, if it's less than that, then it's worth doing the additional. If it's more than that, then it's not worth. So for Q, we're getting 21 extra. For Y, we get 15 extra. Sometimes questions offer us shortcuts, and I can now see a shortcut. If my variable cost for Y, for the additional handling, is 15, I get 15 extra, then I'm not getting any additional contribution to my fixed cost. So I can already decide that there's no point doing Y. So for Q, I need to work out what that additional fixed cost is going to be. And so the fixed cost is 15,000. Across 5,000 is 3. We've got 850 plus the 3 is 1150. We're getting 21 extra, so we should process Q further. You could have gone through the whole process for Y, but like I say, because the additional revenue they're getting from the increased price is exactly the same as the variable cost, there's no point incurring the additional fixed costs. In this question, because they've used the optimum output of this machine that the catalogue tells us, that sounds like an ideal standard. It doesn't take into account any inefficiencies, breakdowns, repairs, so it's unlikely to ever be achievable or attainable, and it's certainly not current because it's a new machine. So you might wonder why I use my scratch pad in reverse order, and it's because if I put something down here, normally what happens when I close it and reopen it, it jumps to the top. So if I was following down, I'd have to scroll down each time, and it gets longer and longer. So I think it's more efficient for me to work up on the scratch pad, so then when I close it and open it again, it's always in the right place for me. Little time saving tip. Time series are always a little bit of a troubling question for students, and I think the Important thing here is really reading the question. They've told us it's already a seasonally adjusted forecast of 2.55 million, and it's the multiplicative model, and we're looking at Q3. So Q3 is this minus 0.04. With the multiplicative model, the formula you need to remember is the market size equals the trend multiplied by the seasonal variation. We know the seasonal variation, we know the market size, so we need our market size, which is the 2.55 million, and we need to divide that by the seasonal variation, but it's given it to us in this format. We need to convert it into a decimal, so we divide by 0.96. So the answer is 2,656,250. So we're looking for 2 and we're looking for the least likely. So big data isn't really about sensitive consumer information, so that's one of the correct answers. It does aim to identify patterns of demand, so that's not a correct answer here. This is a slightly odd question. It doesn't really make sense to detect that correlation, whereas detecting this correlation would make sense. So the 2 correct answers are the first and third. We're asked what the least likely non-financial performance indicator is, and it's a public hospital. It's important you are able to have a definition in your head for economy, efficiency, and effectiveness. What we're looking for really is the 3 that are most likely to be efficiency measures, and then choose the other one, which would be least likely. Efficiency is how we turn our inputs into outputs. Utilization of resources is definitely an efficiency measure. The percentage of an operating theatre that's equipped with an advanced screening device, what that's really measuring or demonstrating is what resources are present in a particular theatre or an operating theatre. That doesn't sound like an efficiency measure. Admissions that have waited longer than national standard have got a relative measure of admissions to some standard, and doctor-patient ratio is a common efficiency measure. For each of these we need to say whether it's correct or incorrect. So the predictability of demand based on consumer price index is higher than import tariff. Well, here's study 1, which is the consumer price index, and here's the import tariff. The coefficient of determination is the measure by which we can predict, and it's actually lower for CPI than it is for tariff, so that one's incorrect. Both sets of studies reveal that both consumer price index and percentage of import tariff are showing positive correction with demand. I suspect that's a typo. I imagine that's meant to say correlation. So if you did this and didn't know what it was talking about, that's an error. Hopefully you did work out that it meant correlation. Now you could do the calculation, so to turn coefficient of determination into correlation, you don't actually need to do it for this, but we might as well demonstrate how to do it. So to find the correlation coefficient, we take the square root of the coefficient of determination, which we enter as a decimal, and then it tells us it's 75%. So that's the correlation coefficient for study 1. However, we don't need to do the calculation here. This is where it's important to read the question. It says showing a positive correlation. To get to these figures, the 56%, you take the correlation coefficient and square it, and if there was a negative, i.e. it's a negative correlation, you would lose that information. So we can't make this statement. This question is really about understanding the scenario. There's 4 different technologies and we need to choose which is most appropriate, and what they're going to do is looking at goods that arrive in the depot and then are dispatched. So they don't need a mobile phone network because it's all in-house. Bluetooth is shorter range. Wi-Fi isn't really used for that, so an RFID is the way you would tag these goods when they come in and then keep track of them. So looking at this question, this all comes down to really knowing what's defined as a contingent cost in the list that you've been given. And a contingent cost is a cost that may happen in the future. So the top one, the material costs and the labour costs, they are all going to happen anyway. The estimated cost of cleaning and neutralising that is a contingent cost because it's an estimate and it is going to happen in the future. Production overheads are not contingent. This is the tricky one, the potential opportunity cost from boycotts. So the correct answer is adding these 2 together. So 2.14 million. I wouldn't be surprised if a lot of people just put that one in and didn't put that one in, but it should include both. For which of the above finished products would it be useful to measure mix and yield variances? And as it tells us, they all use more than one type of material. When we're looking at mix and yield variances, it's only ever worth doing them if the manager can change the mix. And so although there's different types of material, some of these things are not going to be changeable. For example, shoes, you can't choose to put more leather in or less leather in or anything like that. So that wouldn't be worth using mix and yield variance. Carbonated drinks are made up with a series of ingredients, so that would be. Laptop computers, they can't put fewer microchips in or more microchips, so again, it doesn't really make sense there. Cement is something that's mixed. The correct answer is 2 and 4, and often mix and yield variances are for things that are food or materials. So which of these is least likely to use the sales variance? So a cost center is a division that only incurs costs. A profit center is one that only makes sales. Revenue is a combination of those two, and an investment is where they have control over investments as well. The top three here would all benefit from sales variances, but a cost center will have no sales, so that's the least likely. I'll go through question 12. Once you've read it, hopefully you will think there's going to be a few calculation steps here. And what I teach my students is to do what I call blag, flag and come back. So we'd make a guess of one of the answers, we would flag for review, and then I would carry on. I wouldn't answer this question first. I would get up to question 15, and then, only then, if I've got enough time, I can then use my review screen and I can see I've flagged a question, and then I can come back to it. I will do it properly now. There's quite a lot of information here we need to work through. The important things that I hope you picked up from the question is that all labour is fully utilised, so there will be an opportunity cost. If they make these 200 units, it means they won't be making what they normally make because they haven't got enough labour. So we need to work out, if they made these 200 units, what would they get as a result of this 27,000, but also what would they lose as a result of redirecting this labour into the new product. I can see that if we're making 200 units of this alternative product, then it means we're not making 200 units of the original product. I've just put in what we need to work out. We need to find the relevant cost of making this alternate LB, and that will be made up of the materials that it uses, the variable conversion costs, i.e. the labour hours, and the opportunity cost from not making model LA. So what's the materials? So each model requires half the material used for model LA. Well, LA uses 30 per unit, so if it uses half, that would be 15. The variable conversion costs, it requires 5 hours of labour to produce. Well, the variable conversion costs at 30 per hour is costing 75, so this is using 2.5. So we're going to have to double that, so that's 150. And the opportunity cost is the contribution that they're getting from model LA, so it's 140 minus 30 minus 75 is a 35 per unit. But this uses twice the amount of labour. So for every 1 unit of LA, they can only make half of a unit of LB. So we need to multiply that 35 by 2. So that equals 15 plus 150 plus 70, which is 235. So the relevant cost is 235. We now need to know what that is in terms of all units, and they're making 200 if they go ahead, so 200 lots of 235 is 47,000. So the relevant cost is 47,000. They're being paid 27,000, which means they'll be worse off by 20,000. So my blag answer was incorrect. The correct answer is the top one there, 20,000 worse off. This would take me longer than the 3.6 minutes that we've got for a single question, which is why I use this flag method and aim to come back if I've got time at the end. Here we're looking at rolling budgeting systems and which of these is most likely to give us the benefit. The first one, spending more time on preparation, doesn't seem like a benefit. That's a downside. Whilst it's true that a rolling budget does require that, that's not a benefit. This questioning attitude and looking for optimum alternatives is more akin to a zero-based budgeting, and allocation of resources that are linked to results and needs is also zero-based budgeting. There's only one left. It's continuously updated to reflect changes in external market, making it more relevant. That's true. That's one of the benefits of a rolling budgeting system. And we now need to choose 2 of these statements on profit maximizing and output. First one, the total costs at this output level will be the lowest as compared to all output levels. When we're looking at profit maximizing, we're working up through increasing the number of units or the number of batches we produce up to the point where we can make the most profit. So whilst it's possibly true that you can assume the cost per unit gets lower because you get economies of scale, the total costs would actually be increasing as you increase the number of units up to that profit maximizing output. So the top one isn't true. Marginal cost and marginal revenue at this price and output level will be equal. When we're doing optimum pricing calculations, that's one of the key steps to remember, that marginal cost equals marginal revenue at the optimum output, which also correlates to the optimum price. The third one, the marginal cost will be higher than the marginal revenue for output that is below the profit maximizing output level. These are very confusing sentences. So if marginal cost is higher than marginal revenue, and we're looking at a level that's below the maximizing output level, the opposite would be true. Marginal revenue would be higher than marginal cost because we're making fewer units than we would for maximizing profit, and we would only move up from there if the marginal revenue was higher than marginal cost. So that's not true. So by default, this one has to be true. The marginal revenue function in use will give rise to an increasing trend of total revenue for output that is below the profit maximizing output level. You'd be very forgiven for just ticking that and moving on, because that's a very hard sentence to get your head around. It's probably easier to attack it in reverse. So for output that's below the profit maximizing output level, we would expect an increasing trend of total revenue for the marginal revenue function that is in use. So at the point where output is below the profit maximizing output level, the marginal revenue is positive at that point. So therefore, the trend is that the total revenue will keep increasing as the output increases, because that marginal revenue is positive. Let's move on from that very confusing wording. And we need an incorrect comment about life cycle costing. So is life cycle costing more suitable for businesses like this that use advanced information and production technology? That's a correct statement. Is it suitable for manufacturing businesses with high pre and post manufacturing costs? Absolutely. It can only be applied, we've got an absolute here, so my default is that's most likely to be incorrect. Only be applied to manufacturing companies but not to other service businesses? Absolutely not. Life cycle costing can be applied to any type of business and should be applied starting from the design stage. Yes, that's true. On the assumption that you started with section A, we've now finished all 15 questions. If we had any that we had flagged, we can come back and have a look and go back to them, but we would only be doing that if we had time, and we've got 54 minutes. So on the assumption you started with section A, if your countdown timer was below 2 hours and 6 minutes, you should be moving on. If you've got some spare time and you did have any flagged or unanswered, you could go back and do them now. I'll stop this recording now and I'll do separate recording for the other sections.